All right. All right. So let's continue from where we left off last week. So last week we were talking about the issue of financial inclusion, which literally means trying to include the previously marginalized segment of the population. And we all understand why the banks were not really responding to them, because they did not appear profitable enough as a segment to devote resources. Because we know that the provision of financial services comes at a cost, and these banks are providing these services in order to make profit. And so looking at the people in a certain income bracket or in a certain segment of the population, the base of the pyramid, as we like to call them, most banks were of the opinion that they were not fit in terms of being clients for banks because they could not pay for the services. And so the whole idea of financial inclusion is to include these hitherto ignored segments of the population in the financial services space. And that is the essence of what financial inclusion. Now, it's important to understand financial inclusion and then also look at whether there has been an impact. So normally you want to delve into areas of what services are provided and by whom. And to whom do they provide the services? How do they go about it? And what is the impact? Now, when you are able to measure financial inclusion in general, meaning that you're finding out whether people have access to appropriate financial products and services, whether they are able to use them, and whether those services are affordable and of the quality that would serve their needs. Now, once you are able to measure financial inclusion, it helps to understand which segments of the population typically lack certain types of financial services, why those services are not available to them, and also to a large extent which financial services they use. That way, you would know exactly what kind of products and services you can even bring on board to ensure that truly they are patronizing the financial services space. Now, when you're looking at financial inclusion, typically, like I mentioned, is making sure that what people and businesses have access to appropriate and affordable financial services. And we've talked about the appropriateness and affordability of these financial services. Being appropriate provides the convenience, proximity, etc. So yes, the proximity, a number of studies have looked at that, being within, let's say, a 20-kilometer range of an access point is considered close enough. Then also choice, having multiple providers with varied and relevant products and services. And also, of course, the issue of being financially capable to understand the available choices and how best to use them. So, we currently have a study that is undergoing review that actually looked at competition and financial inclusion. And it, in a sense, is captured a number of these issues. How close, or the availability of bank branches typically being a driver of financial inclusion, so that proliferation is an indication for competition, meaning that there are a number of bank branches around, and the ideology is that once there are a lot more banks around, etc., the marginal into the entities that are usually marginalized in the financial services space would be in a position to take up financial services when there's choice. So the choice is both in terms of the products being provided and also in terms of the multiplicity of banks that are available to provide those services. Now, when it comes to increased access and choice of financial services, it doesn't always translate into increased use. So yes, there are a number of studies that indicates that people have bank accounts, The things are available, but it doesn't always translate into the account or the services being used. So when it comes to measuring financial inclusion, it's not always a straightforward exercise. There are a number of approaches that have been used. Key amongst them, so the dimensions when it comes to financial inclusion, they tell you that there are dimensions to the use. The first one usually is access. More like, is it available to you? And so access here is being able to use the financial services, taking into consideration physical proximity, affordability, and eligibility. So sometimes the way we try to measure access is by the number of percentage of persons who have access to a certain type of service and from whom. So let's say access to an ATM. So we can measure and say ATM per thousands, 1,000 persons or 10,000 persons, and the number of ATMs that are available for about 1,000 persons or 10,000 persons to use. That tells you that access has been provided. And so that's one of the key things when we are looking at what financial inclusion and seeking to measure that. So the same way we look at bank branches available per a certain population, and that also tells you more like it's accessibility or outreach. Then we also have the issue of usage, and now that's actual use. Now there are plenty of persons who have bank accounts, but those bank accounts, yes, their names all right, but that is all there is to it. That bank account has never really seen activity, has never seen transaction, has never seen money going in and out. And so whilst access, the fact that, so it's clear that if I live in a community and ATMs abound, it doesn't always mean that I am financially included. So then we have to look at the next level, usage. So being able to use the particular service or commodity provided is one of the other dimensions that is needed or needs to be looked at. Now, frequency or percentage of active accounts. So it means having the account is one level. The account itself being active is a second level. Then we also need to look at quality. Quality here has to do to a large extent whether or not it meets the needs of the consumer. So if you have a bank account which has features that are useless to you, for which reason it makes it difficult for you to transact business, then that does not necessarily settle down to financial inclusion. So you have, in some cases, people have bank accounts and they need to sign the check to be able to withdraw funds. And in some cases, they can't actually read and write, so it becomes a real challenge. So whilst they have a bank account, being able to use it becomes difficult because the features of the bank account does not make it for ease of use. So that becomes the quality criteria. Sometimes that also can flow from the financial capability of the consumers, in the sense that the products are there, but they have no idea how to tap into the right product combination. And so that also becomes a challenge. And of course, when you're measuring inclusion, sometimes even frequency of complaints will tell you that financial inclusion is not being attained. So those are some of the issues as well that you look at. Then we also have welfare, the impact that the financial services have on the welfare of consumers. So indicators, so is it increasing their savings? Is it changing their consumption patterns? Is it affecting their business productivity and decision-making capacity in the household? So it's one of the most difficult outcomes to measure because failure to capture the full dimension means that you may be capturing something that appears to indicate financial inclusion, but is not necessarily what financial inclusion. Now, when we go a step further, we realize that if you want to measure access and usage, then it means that you need to assess both the supply of and the demand for financial services. So here, this is it. When you want to measure access, access is that the financial service provider is providing the products and services so that the consumers can access that. Usage, on the other hand, has to do with the consumer taking up the financial services being provided, so that at one point in time, the whole component of access, which is just one dimension of access and usage, which are just two dimensions reflecting on typically one entity, actually means that you must also include the suppliers of the credit. So now there are a number of supply side studies and databases that use IT to understand what we call outreach and performance of providers. So the outreach here is more like how they are able to reach out to the people who are not included. So outreach is more about how far and wide they are able to cover with their services. So you can find some of this data with the financial access and CGAP, etc. It gives you some information that you might find useful even for research purposes. And then when it comes to the demand side, it's mostly surveys, seeking detailed information about what and how the people use the financial services. So you see that when it comes to financial inclusion, it actually has two sides to the story. That somebody provides the service so that you will be included. Then somebody also has to take the initiative to be included. So it becomes a two-way traffic. So you're unable to fully measure financial inclusion by looking at just one side of what the coin. So now that's something that becomes a useful element that has to be studied. Now, when it comes to the supply side research in terms of financial inclusion, the main issue that we like to focus on is to look at the number of providers. So who are the people out there? In the case of Ghana, earlier on, the banks were in the regions of 35. And then after the financial sector consolidation and cleanup, we currently have 23 universal banks. We actually have about 100 and whatnot plus rural banks, and then we have quite a number of MFIs, and then we have savings and loans. So when you look at the number of providers, it gives you some kind of understanding as to the supply side dictates. Then the next question is, aside the number of providers, what services are used, or the services that are used? So primarily you get credit and savings accounts, sometimes payments and insurance products. So these are the typical ones that you see. In our setting, you find that they just block us into credits, or should I say checking accounts, and then savings accounts and a few other simple accounts. Currently, I think we have some ATM accounts and some kind of special accounts. But give a case in one of the African countries I had the opportunity to stay in for a while, and for which reason I needed to open the bank account. They actually spent some good time understanding who I was, why I needed a bank account, and how I intended to be operating the bank account. So that by the time they finished that kind of interrogation, they were able to provide a particular service that met my needs exactly. So those are some of the things that also we look at in terms of the supply side. how the services are used or how they provide the services that are being used. Then also we look at access points. So aside the number of banks, let's say, available, the question is how many branches do they have? How many ATMs do they have? How many? Currently, we also have the case of what? Agents. So we have agency banking where other persons who are not necessarily employees of the bank have been provided the opportunity to provide basic financial services to consumers through what we call agency banking. Now, so access points also help in understanding the supply side components of what? Financial inclusion. Now, the data is also gathered by regulators, development agents, or self-reported by the providers to the relevant databases so that these can be kept to periodically measure the level of inclusion within a particular economy or space. Now, publicly and generally accessible online. So the IMF conducts financial access surveys annually, and this is made available online and can be used to understand the nitty-gritties of what financial inclusion. Now, when you expand the supply side data to include non-regulated providers, that then a challenge emerges. Of course, we typically don't have all the data. So supply side data can be collected through self-reported databases. So we have the mixedmarket.org, Savings Group Information Exchange, Microcredit Summit, World Council of Credit Unions, World Savings Banks Institutes, Microfinance Transparency. Now, the issue here is that having information on the supply side then begins to also help you to assess to what extent financial inclusion is being pursued and whether inroads are being made. Now, we also look at the demand side in terms of the research. As much as possible, when it comes to demand side, now the reason you want to do research on the demand side, if you look closely at the fact that when we started the story about microfinance, we said that they are unique persons who have peculiar needs that microfinance came to address. So of course, it's important that if you seek to pursue financial inclusion, which is actually at the heart of the microfinance agenda, then you need to know as much as possible how these persons use financial services and from what particular providers. Now, this in a sense gives you some insights as to what they like, what they don't like, what draws them, and what pushes them away. So once you're able to do that, it also helps to identify unmet demand, and reasons why uptake of certain services may be lower than expected. So if you look critically at this demand side research, it is to help you understand the clientele base that an institution is working with. So if you happen to be a microfinance manager, a CEO of a microfinance entity, or even a research entity that has been, should I say, consulted to provide some research data, then of course, your ability to identify unmet demand and the reasons why certain services are not being patronized as expected will play a key role in understanding the clientele base that you face, and for that matter, how you can come up or what kind of products you can come up with to be able to meet their needs. Now, overall, when it comes to demand side research, what we are seeking to look at is one, how exactly do households or poor households use financial services? So how they use the financial services would give you a sense of whether or not the particular service that is being provided is one that is meeting their needs. Now, you also need to, center some information on who is excluded. Because by knowing who is excluded can lead you to understand why they excluded, and for that matter, whether there's a way for you to bring them on board, because you are on a pursuit to include people. Now, of course, the nature of household cash flows will also play a role. So understanding that would also help to shape up or tailor the kind of products and services that will be offered within the space of what microfinance and the pursuit of what financial inclusion. And then also how money is spent, because then that will tell you how the pattern of spending within the space of the poor. So that's for the demand side research. Another thing that actually takes place in terms of seeking to understand the demand side in terms of the users of the microfinance. Okay, I see a chart. 1066. Is it that some people cannot hear me? Or see anything? I think you may then want to check your. I think you want to check.
Okay, madam, we hear you. Okay.
Okay. So let me just respond to this person to check his settings. Okay, so typically non-regulated financial services providers are in recent times, we try to put them under the microcredit, because they are typically not taking deposits. So usually when entities are not taking deposits from the public, usually the regulation is next to minimal. They're just required to join associations, etc., etc. So those are some of the typically ones. So most non-deposit taking institutions are not typically regulated. The regulation comes in more often when they have to protect the funds of the depositors. Then, of course, some regulations will have to come in to ensure that they behave in a particular manner to shield the market. Yeah. So when it comes to the Ghana Living Standard Survey, okay. So when it comes to the Ghana Living Standard Surveys, these are nationwide representative surveys that seek to capture as much data about us as possible, from basic demographics to employment status, and in recent ones, they've added financial inclusion variables to find out those who own bank accounts, those who have insurance policies, etc. Now, so that's another angle where you get some information on the financial inclusion, especially from the demand side. Then we've got the Global FINDEX. It's actually a detailed database that provides demand side survey covering over 150,000 individuals in 148 economies. So this is also information about the consumers' demand for financial services. Then we've got the FinScope. So these are just databases and then info that helps us to understand financial inclusion, especially from the demand side, that is the side of the consumer. So we also have financial diary study. There's data gathered on income, consumption, savings, lending, and investment over a year. So to a large extent, in seeking to understand financial inclusion and potentially its impact on society in general, you need to be looking at both the supply side and the demand side. So here for the demand side, it's about looking at the consumer, what they do, and why they do it the way they do that. so that as a manager of a microfinance institution, when you have to come up with a new product for your market from this class, then you have a clear understanding that for you to be able to come up with the right product, you need to know the clients that you're dealing with, what they like, what they don't like, and why they don't like certain things. So at the heart of this whole issue of financial inclusion is the essence of research. Research that gives you ample data on which to base your decisions, so that to a large extent, your decisions are informed by research. And so when you come up with products, these products are likely to be successful products out there because they meet the needs of the people that you're dealing with. So as a microfinance manager or a board member, as the case may be, then it is important that before any product is rolled out, any service is rolled out, some good research is performed so that the products that are put out there speak to the needs of the consumers. And then that is one of the ways to work towards what? Financial inclusion. Now, so in terms of review for this session, it's important to look at the issue of financial inclusion from a global development perspective. Why is financial inclusion important? You need to now begin to understand the nitty-gritties of financial inclusion and the role it plays in the pursuit of growth and development, in this case, sustainable growth and development. Of course, you need to also know the role that government plays in promoting financial inclusion. That way, if you happen to be a manager, a board member, you are able to know how to engage government, knowing the kind of role that government is supposed to play. If you find yourself within a space which has not provided the enabling environment, because that's the job of government, to provide an enabling environment, then you can actually formulate your course and articulate it well to help government fulfill its role. It's also important that at the end of this session, as we move on, you should be able to explain why it is important to measure financial inclusion. So the question is, what is the purpose of measuring financial inclusion? Can you explain that? It's important that you know, because once you know the purpose and you can explain the purpose of measuring financial inclusion, then of course you'll be a step further to improving upon financial inclusion, which is key in the pursuit of sustainable growth and development. Then you should also be in a position to know that if anyone wants to understand financial inclusion, what are some of the indicators that are typically used to measure and monitor financial inclusion and to conduct research? And then, of course, the purpose of both the demand side and supply side research. So now if you look at financial inclusion, yes, a number of studies have gone on to try to understand what really drives financial inclusion. In some cases, at least, the case has been made that competition drives financial inclusion. And so, in a sense, that once there's more banks come into a particular space and they are competing for clients, then hitherto ignored clientele or consumers will be addressed, because now the competition is going to force other incoming or maybe existing firms, depending on how the competition goes, to reach out to give or be able to service entities who were ignored earlier, because now a lot more banks or institutions are fighting for the same cake. And so some are likely to now expand their portfolio to go into a different case. Now, when it comes to, so that's for financial inclusion. Any comments, questions before I continue? Any comments, questions? Comments, questions? Okay, I see Francis Azubila. Please unmute and speak.
Hello, please, madam, can you hear me?
Yes, I can hear you.
My question is, with the financial inclusion, we were talking about the role of the government. And you talked about providing this infrastructure facility. And you made a mention of about this like providing things and stuff. I wanted to know that in Ghana, most of the ATM joints or ATM machines are being provided by the bank. So I want to know if it's supposed to be the government role to provide them or the individual banks with their role to provide them. Thank you.
Okay. All right. So the role of government usually is to provide an enabling environment. Typically not to provide the service itself. You get it? So the ATMs you see is typically not supposed to be the role of government. But if government provides the relevant infrastructure like internet connectivity, what, then a bank can go set up an ATM at a place because it will have network to be able to operate. So typically the role of government is to provide the infrastructural connectivities, both even in terms of roads, electricity, so that's power, ICT, regulatory environment, a safe place and all that. So it's about government's role is to provide the enabling environment, but not necessarily the actual banks, etc. And more often than not, realize that in a few cases when the government goes into the pure banking segment, sometimes they have a lot of challenges. It is also because then government doesn't typically, in fact, one of the arguments against government getting into the actual provision of the services is the fact that government is not driven by, value in terms of profits. And so government decisions are usually driven by welfare, not necessarily, and welfare is not always profit. So whilst it is okay for generating wealth, for improving welfare, financially it may be a very delicate and sometimes bad decision, if you want to put it that way. So government is typically not motivated by the motive for making money, for which reason the argument has typically been that government should focus on providing the environment so that the the private sector can step in to take on the job of actually providing the services and the products as we need them. So that's the main issue.
Okay, thank you, madam.
You're welcome. Any other comments, question? Okay. Now, we'll look at a bit of what we have for today, and that has to do with supply of microfinance. So here now we are looking at supply. So first we're looking at the demand side, understanding who the people are. Okay, I see a chart. Yeah, the supply of microfinance is a new topic. So we just finished the financial inclusion side. So we're going to supply of microfinance. So that's a new segment. Now, of course, we have deliberated quite a bit on the issue of meeting the needs of the poor. Okay, let's see. Okay. So we deliberated about meeting the needs of the poor, so we know who they are and what they want. Now we want to look at the question of we need to meet their needs by supplying the microfinance. Now, at the end of it, all the objectives we want to achieve within the space of supplying microfinance, we should be able to identify community-based and institutional providers of financial services to the poor. Then we should also be able to discuss the advantages and limitations of community-based and institutionalized or formal schemes. So in terms of supplying the microfinance, what are the pros and cons of both community-based ones or formalized or institutional schemes? Now we should be able to discuss, as a person or as one who completes this class, you should be able to discuss the constraints and approaches to bank entries into the microfinance market and explain how banks and MFIs can complement each other, discuss the challenges facing MFIs and how to overcome them, and explain the factors that determine the success and sustainability of MFIs. So you see, the poor also have a need for financial services, which is literally their demand. Now, the market will be in equilibrium when supply is able to meet demand. So the question then is, we need to understand supply of microfinance, and that is what we are seeking to look at under this topic. Now, when it comes to financial service providers, we can have individuals, and they usually come in the form of money lenders. They lend you the money. Then we have susu collectors, who usually provide some kind of savings for you. We have pawnbrokers, which I mentioned earlier, in terms of taking something valuable of yours and providing the finances in replacements, so that as and when, or you sell it off completely, or you put it up, take the money, when you're done, you come back. We've got traders. They also provide financial services in a way, usually providing credits. Sometimes you buy from these traders, you don't pay up yet, and when the time you're done selling, then you pay. Then we also have shop owners who also fit in that category. And then we have friends and family. So these typically provide financial services one way or the other in whatever capacity they can. Then we have more of community-based groups, and the indigenous ones are usually the Roskers. And then the askers. So these are usually associations of savings and community whatnot. So all these ones, and we also have the burial societies. I believe that one is not lost on you as to what a burial society is. So that's for the community-based. So those are the issues. So when it comes to a moment. So what you have, so yeah, so in terms of the community-based groups, so we have the rotating and savings association. So these are the Roskers. I've mentioned that they save up and give to one person. Now the Askers are slightly different. It's almost the same as they are saving a fixed amount, but some people borrow as and when they need. I see a hand up. Whose hand was that, please?
Madam, please excuse me.
Okay.
Please, I wanted to ask, um, you see, you get financial services. So let's say I don't have money to
Mhm.
pay for my school fees, and then I apply for the student loan.
Yes.
So does it make the student loan trust fund that doesn't make them how do you call it, like people who are providing a financial service for me, and which group among these three do they fall under? And also, please, the burial societies. I don't know what.
Okay. So your application for financial support, let's say from the Student Loan Trust Fund, is a specialized service. It's not an open service. This one, the student loan one, is a specialty service. Let me put it that way. It is not open to the average person who is just poor. You must be a student, a blah blah, have admission letter. So it's a tailored service. So it's not necessarily a financial service provider. Do you get it? This is more like a need. How do I call it? It's not a banking institution per se. Then the loan they're giving you is not how do I call it? I'm not sure they even give you that. That loan they give you is a specialized loan. Even for the students, it's not a typical loan, as in it's a specialized service that is meant to facilitate. We call those ones more of they are social interventions. Do you get it? Those are more of social intervention. So let's say you have something like livelihood empowerment and against poverty program. We call it LEAP. Now, LEAP is more of a cash transfer where certain people who meet certain characteristics are given periodic monthly transfers, either by cash or onto, let's say, their Momo or eSwitch. Now, that one, the money they are being given are not loans. They won't pay back, but they've got to meet certain conditions to continue to receive that that facility. Now, when it comes to the Roscas, it's more, you see, the Roscas operates a model that is almost akin to a kind of banking model, but just that it's not the typical formalized banking. Because you see, if you take a typical bank, I am a sub. So when you did your banking, bank management, you realize that the bank is an institution that brings together surplus spending units and deficit spending units. Now, those who have excess funds come and deposit their money, and then they may get a bit of interest on the money they have deposited. Now, those who need money come and borrow that money, which has been deposited by one group, and then they pay some interest as the price for being allowed to borrow the money. Now, that's the typical banking or financial intermediation model. Now, when it comes to money lenders, for example, they are providing the credit. The only thing is that they are not allowed to collect the savings or the money that they are giving out. They are not being allowed to collect from the public, the general public. They can only collect from certain people, friends, family, however. So they are not allowed to collect from the average person walking on the street. So that takes them out of the banking model. Just that they still provide a financial service. It's a loan they are giving you. So they are giving you an aspect of the financial service frame, which is providing a loan, which you will pay back with interest. The clause is that they do not get to take deposits. Now, when it comes to the student loan issue you mentioned, they don't take deposits from you. And then the facility they are giving you is not open to the average person on the street. It's only for a unique population. So that one is more of a social intervention and not necessarily a banking service. Now, when it comes to the askers, which is the Association for Collective savings, etc. What they do typically is that the members save regularly the same fixed amount, and then some participants can borrow from the group. So they charge interest on that, and then you pay back. So what you have is typically a model where you find that they're just creating some kind of banking framework, just that it's not a very formalized should I say group. Now with the burial societies, typically these are also like just savings group, and they're more like their own how do I call it? So they usually I don't know how to put it. It consists of members who just contribute monthly fees or periodic fees, and then they pay out when there's a death of a member. So like you see, because of life cycle issues, like we mentioned, which actually affects the poor a lot, and death is one of them, it's become more like a welfare of a kind society. So the burial society, and of course, death is one of the key things that can mess people up. So this becomes a way of cushioning such persons. Then we have groups that we call them more like facilitated groups. It's because these are just general savings groups, and they are facilitated because usually there's somebody who's coordinating that more from a slightly formalized angle. Then we also have standard self-help groups. Then we also have registered institutions. We have the normal financial cooperatives. So a group of people come together and then they want to help themselves, and then that becomes a finance. So they are cooperating together. Now, when it comes to the circles are typically just a savings and credit cooperative society. So it's usually they're just member-based entities. They come together and they help themselves. It could be a particular feature that may bring them together. Then we can also have suppliers and buyers who also then provide services to one another in one way or the other in terms of credit, typically. Then we have non-governmental microfinance institutions. These are usually NGOs that have moved into the space of providing financial services. So sometimes we call them financial NGOs. And what they typically do, they are getting their money from donors, and then they give credit and follow up. Usually the credit is almost without interest, or if there's interest, is so negligible, it makes it very friendly. And of course, there are insurance entities, and then money transfer companies, mobile network operators. Now, these typically provide forms of financial services, both in terms of opportunity to deposit funds in some cases on your own, let's say, Momo interface, or transfer money to make payments. Then, of course, we are back to the issue of the regulated financial institutions, which somebody asked earlier. Now, these are typically, like I mentioned, typically deposit-taking institutions. So deposit-taking MFIs are regulated. So like I told you, typically, once they start taking deposits, then they fall under certain regulations, because then the regulator is seeking to protect the depositor. So once you have a savings and postal bank, meaning that you are saving with the bank, your money goes there, it becomes regulated. Then we have state banks, that one we know. And then we have commercial microfinance banks or commercial microfinance institutions, those in the space of providing microfinance, but with a profit orientation. So they are slightly different, or should I say intrinsically different from the financial NGOs. Then we also have non-bank financial institutions, sometimes leasing houses, etc., who provide credit, and given the conditions under which they provide credit, they must be what regulated. Then we also have commercial insurers. So that one we know them, and they also provide services for the microfinance segment as well. Now, when it comes to community-based providers, for example, when it comes to them, mostly they provide informal financial services as far as the Sub-Saharan Africa is concerned, in the sense that there isn't much of paperwork and formalization, even in terms of the registration, etc. It's more of mutual trust, etc., on the part of the members. So that's what you have in terms of the services provided by these community-based providers. Now, the main advantages that community-based schemes do give has to do, and of course we mentioned that that's one of the key things that makes microfinance what it is, the convenience and proximity to where the people live. Discipline to encourage regular savings and low payments. Low transaction costs. Accessibility to funds. Flexible terms that usually can accommodate uncertain cash flow. So as and when you have the money, then you make the payment or you make your deposit. And then very minimal administrative procedures. And then, of course, the key thing, no collateral requirements. Now, this is usually what gets a lot of the poor people off the market for formal banking. Now, when we go a step further, realize that they also come with disadvantages, meaning that for the rosters, etc., they only have a limited product offering, meaning that they have particular services. So if it's you all contribute, and then you make it available to AMA this week. Next week it is Akosia. Now, in some cases, some people may not necessarily be in need of the funds, so all they need is a place to save. Now, sometimes these community-based providers may not be in a position to provide the variety of services that are needed by the members. So the limited product offering is one key disadvantage. Then there's also the issue of potential unreliability. So that it's not always reliable, partly because also it flows from the issue of vulnerability to collapse, fraud, corruption, and then collective shocks. Now, collective shocks can happen in the sense that something happens in the community, and then it affects about 5 of the contributing members of a ROSCA. What it means is that those people may not be in a position to make good on the contribution that is required. That automatically could make it vulnerable to a collapse. So let's say that there are about 10 people in a group, and each of them pays 100 cedis at the end of each month, which will come down to 1,000, which goes to one person to go do whatever they want to do for a particular month. And then the next month, it goes on and on and on. Now, in the event that and remember that they are all within the community. So there's a flood or agbogoloshi, there's a fire, and then it affects about 4 or 5 out of those members. Now, the remaining 5 or 6 persons, first question is, the remaining 5, have they already collected on their contribution. If they haven't, and the people who are supposed to contribute for these other persons to benefit are the ones who have been affected by this, calamity, then it means that we have a big problem, because then those 4 or 5 people may not be in a position to contribute, which automatically means that the other beneficiaries are going to have a challenge being able to collect on their due payments. So yes, a number of things. And in the issue of fraud, there have been cases, and I've heard of cases where some people are members of the group up until they get the funds that are being rotated, and once they collect it, they walk. So in some cases, the person is number 2 or number 1. They fight and everybody, and they collect. Once they manage to collect, they cease to be members of the group. Then, of course, the issue of corruption will come more from, of course, accountability issues from those who will be collecting and keeping the funds. Now, community-based providers also run the risk of creating stigma or loss of dignity, because in some cases where some people are unable to meet up on the periodic payments as required, then it becomes an issue of stigma and then ostracized or being ostracized from the particular community by the fact that you are unable to contribute accordingly. Now, of course, when it comes to the informal and community-based financial services provider, we can group them into 2 main categories. Either they are indigenous, it means that they sprang up on their own and facilitated within the community, or typically facilitated by some financial institution that has an interest in expanding financial services to that particular community. Now, as for the institutional providers, they are a bit more formal in nature. Typically, they have brick and mortar buildings and branches. They are registered, and often they are regulated. The main thing is that they lack the flexibility and proximity of community-based providers. But the good thing is that they actually can offer a very broad variety of products and services. Of course, to a large extent, that can make them a bit more expensive. And the products and services they offer are usually influenced by their legal structure, the regulation, capacity, mandate, and target market. Now, when you look at, let's say, banking, for example, we have what the microcredits can do, what the microfinance can do, because they also take deposits, but then there are caps as to the amount of money they can take from one person and the kind of loan they can also give up. Then we have savings and loans, and then we typically move into the banking space, the universal banking space. Now, each to his own in terms of the appropriate legal structure, the form it can take, the regulations that hold it, its capacity, the mandate, and then more importantly, its target markets, because then that will tell you the kind of products. So when you go into mainstream universal banking, they have certain products that you would not find within the microfinance space because of the target market. So typically the more institutional providers, they are quite formal, quite regulated, because they normally take deposits from persons, from the public, the larger public. And then their legal structure and etc. would influence the kind of products and services they give. Now, let's look at deposits taking MFIs. So as you can clearly see, it means that there are MFIs that will not take deposits. Typically, we refer to those ones as the microcredits. So yes, they are within the microfinance space, but their focus is on giving credits using funds that are coming not from the general public, like being open for deposits, but from their own sources in terms of family and friends and other investors, high net worth individuals. Now, when it comes to deposits taking MFIs, they mobilize and then intermediate deposits. and they may be licensed and regulated as banks or operate under a special category for MFIs. Now, when it comes to their funding sources, usually we're looking at equity raised from shareholders, but they often borrow from a broad range of lenders as well as the capital markets. I believe you are not lost on what capital markets stand for. You know about equity as well. Now, deposit-taking MFIs are a form of non-bank financial institutions because they are typically not referred to as banks. They provide financial intermediation, but they don't meet all the stringent regulatory elements that make them non-bank, so that they fit more as non-bank because they don't have the pure banking license, which actually comes into the room. So they don't have a full banking license. So they can take from a segment of the public, and there's even their caps on sometimes how much they can take, which is not necessarily a limitation for the traditional banks. So deposit-taking MFIs can be classified as a form of non-bank financial institution because they are not with a full bank license. They are more of an interim step sometimes to obtaining a bank license. Now, whenever we have deposit-taking MFIs, then they also face the need to balance shareholder value and returns with a need to serve the poor. So you see, this one becomes a yo-yo. Shareholder value means make as much value for the shareholders as possible. But at the same time, the role of a typical microfinance is to serve the poor. Serving the poor who don't have money means that you cannot make as much profit. So the question then is, how do you balance the need for shareholder value and returns with the need to serve the poor and needy in society? So that's for the deposit-taking MFIs. Now, over the years, the banks have come to realize that there's a need to also provide or step in to provide microfinance services, partly because they've got coverage and also because they've got more financial muscle. So a number of banks are seeing the microfinance space as a new area of growth and profitability, especially as competition is leading to dwindling margins. So you see the segment of the markets that the formal financial institutions, typically the banks, were focusing on has become constrained. Constrained because there are so many banks pursuing these same clients for the services, for this, for that, for that. What it means is that whatever is there to be taken has been taken. Now the question is, what next? And of course, the fact that the market has also been deregulated, meaning that there are no rules about caps as to what you can charge for interest and what you cannot charge, etc. It means that banks can charge market interest rates wherever they go, because typically some time back, the poor were shielded. Now the deregulation means it's an open market. There are no caps as to what you can do and what you cannot do. So with a huge financial base of banks, their large infrastructure, their human resource, and their broad branch networks, it's possible that they should be able to serve the microfinance market very well. And more importantly, banks are now looking or seeking to provide, because international agencies and donors are also providing banks with technical support and training in the microfinance space. And so that provides a very good opportunity for why banks will now provide microfinance services. Now, so the question then is, the banks are giving credit, and then the banks are giving credit, MFIs. So the question is, how different are they? Now, for banks, it's clear that their orientation is for profit. But when it comes to MFIs, they actually have a double sword. On one side, they need to be sustainable, but on the other side, they're looking also at meeting the needs of the poor. So there's a social aspect to their quest, especially for financial NGOs. They don't have a profit motive. Now, when it comes to banks, they do offer large product services to typically corporates and individuals, but the MFIs, their targets are for small entities, micro enterprises, and then poor borrowers. So you can see the differences. The banks are looking for the large, rich clientele, whereas the microfinance want to focus on small businesses and poor borrowers. Now, banks provide mostly generic products in general to the public. MFIs usually provide mostly tailor-made. Well, in recent times anyway, that has come under attack because they seem to be copying the banks more and more by the day. So we're having an issue of what we call mission drift, which will come up much later in the course. So typically the difference should be that MFIs are normally working on providing customized services that will address an issue of convenience, proximity, and all that. But in these times, it seems that that is slowly disappearing, but that's supposed to be one of the defining characteristics that makes an MFI different or separate from the banks. And then when it comes to the banks as well, they usually require collateral, but MFIs rely on collateral substitutes such as group-based lending, compulsory savings, etc. So the MFIs rely on other forms of collateral that are typically not referred to as the traditional collateral. You know, with a bank, you put up your car, your house, your land, something of yours. When it comes to MFIs, they usually leverage on societal relationships to provide the pressure for you to pay, because relationships or social networks or social links for most people in such areas are key and paramount. Families are interlinked, etc. So that is one way they use as collateral, because you don't want to become the black sheep among your community members. So if you owe, then it means by pursuing, let's say, for example, the group lending model, then you want to pay up, because your failure to pay may mean that your group members will be forced to pay your borrowed funds, and that means that you are likely to lose the relationships with the people in that group. Now, even though banks are seeking to enter the microfinance market, they face a number of challenges. One of the most critical ones is the high credit risk. And of course, high credit risk is known to be the bane of many banks, for that matter. Failure to collect on their loans leads to the banks failing. And so one thing is clear: when it comes to these poor people, you don't have a lot of hard data. When I say hard data, people, you know, the typically poor person usually doesn't have a formalized job, contract with the employer, a home that you can easily identify by way of address, etc., in essence. So that, and then you also lack that kind of information that helps you to do a formal credit appraisal, so that there's a high inherent risk embedded in the microfinance model. And that is an aspect that banks struggle to deal with, because they haven't fully been able to decode these poor borrowers to the point of knowing how to work with them. So for that matter, the loans that they give them typically go bad because they are unable to navigate the waters to collect on such. Then the challenge also is the lending methodology, because the lending methodology that thrives in the microfinance sector is not based on hard information, which I've mentioned already. It's mostly based on soft information, relationships, etc. Now the banks are unable to, for now, leverage fully on that. So the lending methodology also poses a risk for them. Then there's an issue of cost effectiveness. Now, by virtue of the poor being unable to pay up for certain services, the sophistication of banks usually means that they have certain fixed costs that are quite high. In general, getting to become a bank comes with a lot of fixed costs, high fixed costs. So now, I think with this we have discussed fully the ability to be able to, or the ability to get these financial services for these poor persons at a rate or at a fee that covers your costs becomes problematic. And then of course, sometimes the institutional commitments, you have your commitment to your shareholders to provide certain returns on their capital provided. And that makes it difficult sometimes to move into the MFI space. Then we also have the issue of organizational structure. For MFIs, typically the structure is flatter in the sense that there isn't too much of bureaucracy and some decisions can be made fast and smooth to accommodate the flexibility that comes for working within that space. Now, when it comes to bank, they have more formalized structure. And so sometimes it becomes difficult to navigate the bureaucracy you find in some of these banks to be able to deal with the needs of the poor. Then the issue of human resource. The microfinance space requires a certain caliber of human resource. And for the banking, the generic banking sector, they seem to lack that particular, because you need to have sometimes somebody who can speak in their local language, explain issues to them in a certain way, even sometimes understand the cultural dynamics. I'm sure there are cases where if the chief wants to borrow money, the chief won't come to the bank. It might be the Chiami who comes. Meanwhile, the lending is, or the loan is supposed to be for the chief. How are you able to coordinate these two pieces? Now remember, typical banks will only go to the homes and offices of prestige clients who are paying a lot in terms of what bank charges for you to visit them at home or in their offices. Now here comes the case where you have a chief of let's say some poor community. It doesn't change the fact that this person is a chief. So you may want to engage this person. You need to visit to go and get the loan signed and whatnot. Now that becomes an extra cost, one, and also under having somebody who understands the dynamics of community entry, for example, knowing how to engage the community without stepping on toes, etc. That becomes a challenge for them. Because what it means is that each community is different, and so you must train the human resource for each community differently. Now that becomes a bit more of a stressor. A typical community-based bank, for example, works within that bank. So if you have a Abokobi Rural Bank, it's working within Abokobi. It tailors its whatnot to the needs of Abokobi, and everything is Abokobi. And so their human resource have been tailored to the needs of Abokobi. Now, when you bring in StanChart, for example, StanChart will actually may have a group policy that is more global. So it means it works across all countries across the world. Then even in Ghana, we've now currently got 16 regions. And within the 16 regions, we have 275 constituencies. Even within the constituencies, we've got tons and tons of districts and what level. Now, each district, municipality, assembly, metro, whatever, has unique characteristics. So can you imagine that Stanchart, for example, has branches across a number of units? It means Stanchart must spend funds and whatnot to train each community branch of their bank to be able to fit in. Now, by the time they are done with that, they're most likely going to be bankrupt and not going to make it worth the effort of entering into that market. So this is a challenge that banks face also in seeking to get into the space of the MFIs. Then we also have the socioeconomic and cultural barriers, which are linked, like I said, so is linked to one, not having the right human resource to be able to get to the ground. And then this, in a sense, is linked to the socioeconomic and cultural barriers as well. Then there's also the issue of regulatory compliance. Sometimes I indicate that one of the things I say in passing is that UT may have collapsed because maybe it wasn't yet ready to be a bank. So you see, this is one thing. When you're operating as, let's say, some microfinance or non-bank financial institution, certain rules don't work with you in the sense that you are not that regulated. So as UT, for example, when they give out credit and you're not paying back, I've heard of stories where some people have taken credits. I've heard of stories where some people have taken credits and then failing to pay, UT has gone to their homes with macho men, and literally one joke was that for some particular person who took the loan and didn't want to pay, knowing that the UT people will be telling him during the week, he parks his car at home and does the trotro because he had used the car for collateral and the loan was up for payment. He couldn't pay up. And so during the week, he parks the car at home, locks his main gate, and then uses trust key to go to work. Then on weekends, when let's say UT is not working, then he uses the car because he knows that what? There won't be anybody working on Saturday, Sunday from UT to come and chase him. Now, of course, the joke is that UT sent people to his home. They knocked down the pillars of the gate, took the gates down, towed the car out, and then finished and then put the concrete, replastered the wall and the gate in place. Now, of course, that's a hypothetical one, but there have been cases where UT has sent persons who have met defaulting clients in traffic and then have just stopped them, asked them to leave the car, and then they have just driven the car to their impounds or their garages and kept the cars there. And where the person has failed to pay, they auction the car and retrieve the monies that they can. Now, once you become a bank, there are certain compliance issues that you must deal with. And that suddenly, so in fact, when you're a bank and you do certain things, even the customer can still take you to court for harassment. And so the cloud changes. Now, once you begin to operate in that field, then you've got a bigger problem. So then by the time they converted to a bank, I think some of the compliance issues, if you ask me, began to hit them because what you used to do as a non-bank, now you cannot do as a bank because it's not part of the code of conduct for banks. And that started hitting their books financially. And then with time, they just went under. Now, when it comes to the banks seeking to still enter the space of microfinance, they sometimes what they do is they can go the direct route where they established an internal microfinance unit. So like they downscale and then have a desk for microfinance, or they actually will set up a completely specialized financial institution. Like we have those and the UniCredit and the EB Action by EcoBank that then deals with just the microfinance segment, so that they still have their mainstream banking, but then now instead of having just a desk, they manage to rather create a whole financial institution. Or in this case, they'll set up a microfinance service company separate on its own, and then also providing services within the space of microfinance. So there are ways, depending on the skills and capacity they have, that's what they leverage. Then they have the indirect approaches where they can outsource their microfinance operations to somebody else to do on their behalf, or they give out loans to existing microfinance to be able to onward lend to the poor, or they try and provide infrastructure and services to microfinance. In some cases, you may write a check on a certain microfinance, but it will go through a certain bank for clearing because that's the kind of collaboration that they do. So those are some of the elements. Now, the question is, can the banks therefore work together with MFIs? Because it's obvious the banks have the money and the clout, and the MFIs typically have the soft knowledge. Now, one of the ways that banks can do that will be to lend to MFIs who will in turn lend to micro borrowers, so that MFIs end up playing like an agent role or a point of contact for a bank, so that the rural masses are able to access financial services. Now, of course, a bank can also appoint the MFI as a business correspondent for distributing their products and services to their rural clients, so that maybe a particular service that Stanchart has could be passing through something microfinance, so that the poor person can walk into their microfinance institutions. In general, when you're able to achieve some strong collaboration between the banks and an MFI, it's beneficial to both parties, in the sense that the MFIs get to reach out to the poor using the skills that they have. And then the banks are able to also indicate that, yes, they've been able to reach out to the poor through that. So instead of being competitors, they can actually become partners in the quest to aid and improve upon financial inclusion, and then aid in poverty reduction, etc. Now, this is not to say that microfinance firms also don't have challenges. They do. One of the key things is also they also lack the human capacity, both in terms of skills and head count. Then they also face inadequate infrastructural support and a general high risk in general from both the credit side and everything. Sometimes they do lack coordination, partly because a number of them don't have strategies anyway. And then adequacy of information is also a challenge for them. Adequacy of funding is a challenge. And then weak regulation and supervision also becomes a threat to their long-term survival, because the lack of regulation or the strong regulation actually plays out in affecting their viability and sustainability in the long run. Now, if you are to succeed as a microfinance institution, there are some things that you need to keep in mind. Key is leadership quality. Leadership quality. Now, one way you can say to lead the ship. So if you don't have the skill set to lead the ship, then you're going nowhere. So one of the key things for the success of every microfinance is the quality of leadership that they have. So if you choose to do any study by assessing the leadership quality of maybe successful versus failed microfinance institutions. It might be a way to begin to interrogate the issues as to the qualities that, so here we say leadership quality, but then we must definitely go, so that's where research also becomes very important. So those of you may be looking at, I'm sure you've done your long essay, but in the event that you want to do some basic research or inquiries, you want to start interrogating the kind of leadership traits that are important for success and sustainability of microfinance institutions. Then you also need talented staff. Talented staff, because working with the poor is a unique space, and so you need people who are talented and able to adapt accordingly. Also important is the need to have innovative products and services, not the business as usual, but services and products that speak to the hearts of the consumers. It speaks to their needs. So that's what you want to do. Now, another thing is key. You may have to rely on subsidies. So the question is, how do you generate that? Okay, so somebody is asking, with the first points, the banks have to lend at a low rate to the MFI so they can borrow. They can also lend to customers, else they would have to do so at a high rate, and the objective will not be achieved. Yes, exactly, Patience, you are so right. So it has actually been a challenge as to how to find the right rate, because sometimes by the time all is said and done, like you so rightly said, the objective of reaching out to the poor is defeated, because the loans that get to the poor are so expensive that it actually makes them worse off than they are. So last year I got a student to look at microfinance and say something about like the good, the bad, and the ugly. So whilst yes, they make noise, that microfinance has the potential to help, like you so rightly said, because of their inadequacy of funding, and they are forced to rely on traditional banks sometimes for some of the funding, it comes at a very expensive rate. And by the time they are done lending, they've actually killed the poor instead of helping them to stand. So that one is key. So there are times for you to be sustainable, you need to find a way to tap into subsidies, because then subsidized funds without high interest rates or almost zero interest rate is key. Then you also need sound financial and risk management capacity. So sound financial management capacity, sound risk management capacity, very important. Now, I'm sure when you did bank management, you realize that managing a bank is different. You need to balance your assets and liabilities in such a way that gaps are not created within the maturity framework of your assets and liabilities, which then results in the case that when interest rates are changing, sometimes your loan rates are falling faster than your liability rates. So if you've gone to take, for example, you've borrowed funds and the funds are on what we call flexible rates, it means that every time interest rate goes up, your cost of deposits also goes up. Meanwhile, when you were lending, you lend most of the money on fixed basis. So whilst interest rates are rising and your cost of deposits is going up, because the loans you've given out are fixed rate loans, interests don't change, or interest rates don't change on your loans. What it then means is that deposit cost goes up, money is not coming in through an increased loan interest channel for you to pay up. So you find yourself wanting, and that can actually be your undoing. So A very good understanding of financial and risk management is key to ensure success and sustainability of MFIs. Now, another thing is also the diversification of a client base. Of course, I don't have to belabor this point because it's quite clear. Diversity will ensure that your risk profile in general is not as bad. If you put all your eggs in one basket, you have a particular kind of clientele, then it means that your risk will be high. For those of you, I believe, who did business finance, this is where you realize that the kind of correlation between any two assets. So remember that when you give a loan to a client, that loan is an asset. If you give it to client two, the loan for client two is also an asset. Now, the capacity of the clients to pay the loan will literally determine the viability, or should I say, the profits or return potential for that loan. Now, if those client one and client two are almost identical in behavior and characteristics, it means that loan one and loan two are like two assets that are what? Positively correlated. So when business is good for the area, since loan one and loan two are literally identical, the effect will be the same. And when business is bad, the effect will be the same. Now, so when you have all your eggs in one basket, meaning that your loan portfolio has a particular trait running through all the clientele, the risk for you is that in the event of a shock, you're likely to go down. So one of the key things also is to have a diversified client base that ensures that at any point in time, in a sense, your loan portfolio is also diversified, which then reduces the risk, because I'm sure you've come across the issue that diversification reduces risk. So it also plays a role here. And then another key thing will be to see to prudential regulation. Now that brings me to the end of this session. So you want to go back and be looking at, put yourself in the position of the CEO of a microfinance and begin to understand the nitty-gritties, especially in terms of what makes for successful and sustainable MFIs, and then get to understand the issues under that. So I'd want you to spend some time to look at the issues of leadership quality, staff, innovativeness of your products and services, subsidies, sound financial and risk management practices, diversified client base, and prudential regulations as being cornerstones to the success and sustainability of what? MFIs. So that brings us to the end of today's session. Comments, questions before I wrap up the class? Any comments, any questions? In the meantime, attendance, please. Okay, I see a hand up. You can talk whilst people are typing.
Yeah, hello, madam.
Yes.
Yeah, please, under the constraints banks face in the microfinance sector,
Yes.
said organizational structure. I didn't understand the meaning of that one, the organizational structure.
Okay, so usually, like I said, there's more bureaucracy in the standard banking sector. There's a lot more bureaucracy, how things are supposed to be done, who should authorize this. When it comes to microfinance institutions, they're usually flatter. There's usually the CEO and then one or two general managers, and that's that. Now, when it comes to the banking sector, certain decisions must go through, a real chain of command all the way to the CEO. It's not that when it comes to the microfinance, it's way flatter and way simpler. So what you find is that the organizational structure sometimes cannot allow certain things to be done. So you see, with the banking sector, therefore, the products are more standardized. So they've worked out a particular product and it goes. Now, with the microfinance sector, every client typically might end up with a new product that is not purely in the books. What it means is that each one will need to go to a decision-making point. Now, for the pure banks, that means that you need to go through the chain of command, the hierarchy, and sometimes all the way to the board. Now, with a microfinance person, if you go through the structure, by the time you are done, the person is already dead. They need some 200 cedis. Even the whole procedure of rising all the way to the CEO and the appropriate documentation that must go with it is enough to make it not so useful a venture. So that's actually one of the main reasons that the organizational structure for the typical bank is way more bureaucratic. So it does not feed well into the flexibility and the customization that is required in the typical microfinance space. Because with a typical microfinance space, almost every client will end up becoming a unique a person that you must deal with on a one-on-one basis, in a sense. And that is not something that is fostered by the typical banking structure. It's strict, there are controls, there are issues. You can't do this, you have to do this. If this has to go, it has to go here. Get this person to endorse, this person to write this person to approve that. Now, by the time that is done, I'm not sure your client will be there waiting. They may be dead already. Yeah. I hope that clarifies it for you.
Yes, thank you, madam.
Okay. So barring anything, I think we meet on Friday. So have a good evening, everybody.
Madam, my hand.
Oh, sorry. So somebody's hand is up, okay?
Okay, Madam, okay. So thank you very much. I think tonight you said a lot. Okay, but I want to ask a question that I think the problem with the microfinance is also the fact that some of the services of I think some of the services of the banks are, or let's say the rich, are tailored to their activities. So for example, the rich are always seen on the computer, on the phone, and then even paying something over the counter. So you look at the financial services that goes with mobile banking, because the guys or the gentleman is always on the phone. So the bank is on the phone. And then maybe it's over the counter buying something. So the ATM looks like something that you are buying over the counter, standing up. I just want to create that. So why is it that this MFI don't employ, let's say, financial service that would tell how the poor lives? So for example, the poor is seen at the market. So you take the bank to them at the market. The poor is seen at the, let's say, in the farm. So there you can tailor your financial service now, be with him at the farm. So maybe as the indigenous person will take the susu to the farm, because when you go to where they do the market, you kind of get more of let's say deposits from them, because before they will decide to walk to the bank, they've put down some, let's say they've deducted certain expenses, but that's before they walk to the bank. But in this case, when you go to them with their at where they do their market or where they sell, you would see that maybe they may even be impulsive savings, so that although they will spend, they will just, okay, you keep it when I need it. So in that case, the poor will still be using the financial services more and more. This is talking about the I think the problems of the MFIs. Okay, thank you very much. That's my answer.
You're right. So yes, actually, what you're saying has been around for a while. Just that they are still finding ways of navigating. So, like you say, taking them to the markets, the farms, the whatnots to go and take deposits from them. It's happening. In the initial stages when it started happening, the MFIs were working on trust because they didn't have the money to invest in the appropriate softwares. And so what started happening for some of the MFIs was that some of the people they sent out as agents or as collectors went, collected the deposits from the poor people, pocketed the money and absconded. Now, for that matter, a number of MFIs have had to, those who could afford some or get support to afford, have had to buy softwares, buy gadgets, so that these gadgets become like a mini banking platforms that these agents will walk around with. And when they collect money from the MFI clients, they book directly into the system updates the head office, and then they are able to issue a receipt. Now, good as it is, for some MFIs, they struggle because the money required to set up that facility becomes a bit more expensive. So yes, you're right in saying that setting up an MFI means taking the banking service to the client. But like I mentioned earlier, formal banks do that because the client pays more money. But here is the case that this client who is literally requiring that you come to their home or their workplace or their farm or the beach actually hasn't got much money to pay. So then the dilemma or the challenge is, how do you still take the service to them without running yourself bankrupt? And that is actually the challenge you have to be thinking about. So in fact, at the end of the session, I'm going to come up with 1 or 2 assignments, and part of it will be how to navigate this terrain, coming up with products that are still affordable, but takes the financial services to the remotest part and reaches the unreached, that is the typically poor. So those are things you should be thinking about. Yes, some institutions are doing that, but they're having challenges. So the question is, how do we navigate those challenges so that we can continue to provide financial services for the poor? Yeah. So that's.
Okay, thank you very much.
Thank you. Okay, so then let me see. Who are these late comments who are now writing names? My class has ended. No more name writing. Okay, so now good night to you all.
Good night, madam. Okay.